Hola, and welcome to class today. I hope you're enjoying this class either in your pajamas or at work or, well, anywhere but class, so that's awesome. So I hope you guys have a good time with this presentation. A good time? I hope it's satisfactory. And we're going to go over a few things. Today's the basics of investments. And we talked about before in class about my belief in investing, and I believe that investing is a long-term plan. I don't believe in gambling. I believe that if you want to gamble, you can go to Las Vegas and do it there. So today, what I want to talk to you about, primarily first, I'm going to talk to you something about called the investment policy statement. Very important. Before we get to investment policy, before we get to actually choosing investments and fund selection and looking at different things, we've got to understand what an investment policy statement is from both the consumer's standpoint, the client standpoint, and the financial planner's standpoint. We'll move into selecting funds. How do we select mutual funds? Remember that we want diversification in financial planning. We don't want to be invested in one asset. We want multiple assets because multiple assets provide something called, we want diversification, obviously. And what we want, and to find good diversification, we want to find assets that are not correlated. So bonds and stocks, those are typically not correlated because now they're not perfectly uncorrelated. But typically when stocks moves up, bonds move down, and vice versa. So we want to make sure that when the market drops or the economy goes south, that not our entire portfolio goes down. Okay, so we'll be talking about types of mutual funds we can use to have diversification. But I'm also going to talk to you about a prospectus and about fees and expenses, and we'll also look at some investment statistics today. So this will be fun. So what is an investment policy statement, or the IPS? Basically, it's an agreement with yourself, okay, and the way you're going to manage or invest your money, okay? You're committing to a disciplined investment plan, all right? The agreement is usually between a client and their investment portfolios. So, for example, a investment policy statement, I'm going to say in that investment policy statement that what's my risk tolerance, number one, okay? Risk tolerance. So what is my ability to take risks? All right, and I'm going to give you guys a questionnaire on how to identify your risk tolerance because it's really important to identify your risk tolerance. And it'll look at your current allocation. So if a client came to us and was invested 100% in stocks, but they said that they're not willing to take a lot of risks, well, we've got a problem with our investment policy statement. The way you're investing does not represent your risk tolerance or your ability to take risk. So the investment policy statement would say, hey, what is your current allocation right now and where do we want to get to in the future? All right, so if we're going to invest, if you are risk averse or if you don't like taking risk, we're probably going to start moving you more into bond mutual funds or less risky mutual funds, okay? We're also going to, in addition to risk tolerance, in addition to our current allocation and what we're going to do with the money, we have investment philosophy. There's a lot of different investment philosophies out there. Different financial planners and investment managers have different types of philosophies when it comes to investing. My philosophy is, number one, I believe that over the long run, the markets will do well. Okay, and I don't believe in overly paying someone to manage my funds when the market can just make money on itself. And we'll use something called an index fund to achieve that. Maybe an index fund that it overlooks, or maybe an index fund that seeks to perform or track the S&P 500. Okay, so there's investment philosophy of a passive investment approach, or maybe we take an active investment approach. So an active investment approach would be what? The actual financial planner or investment manager would strategically make trades, usually not on a daily basis. We're not talking about day trading here, but would make trades, rebalancing the portfolio at a quarterly basis, looking at the market. Is it a good time to be in gold? Is it a bad time to be in gold? Are large cap stocks, are they overpriced, underpriced? Where do we see the economy going? And that's a little bit more active management with mutual funds. And that's one thing. So we have the way we're going to, our philosophy investment is a big thing. Our investment objectives is huge. What are our objectives? Okay, and what's our roles and responsibilities would be the next one. So my role as an advisor is to make sure that we invest your money that's going to meet your investment objectives, that is within our investment philosophy, and that we're getting to this allocation that meets your risk tolerance, right? Okay. Your responsibilities as a client is to let us know if you're uncomfortable with something, all right, and let us know about any types of situations in your life that might change the way we invest your money. For example, if you're going to have a big cash outflow moving forward, and we're managing a large amount of money for you, or you're managing a large amount of money for a client. Let me get rid of that here. Let me back up here. Okay. Is an investment suitable for you? Okay, looking at suitable investments. All right. And then back to what I was talking about before, if you have a large expense coming up, or you plan on maybe moving or selling a house, well, we might want to have some of your money in a very liquid investment. In order to pull that money out, we wouldn't want that money in anything aggressive. Suitability is a huge issue. What are you suitable for? All right. So, what kind of investments you're suitable for you? For example, we might do mutual funds. We might do index funds. We might do ETFs. We might do but we may not invest in specific. We might say, no, we will never invest in individual stocks or purchase individual bonds or put money in a hedge fund or what's called a private placement. For example, back in the day when I was in financial planning, we would recommend every single client to have about 10% of their portfolio in a hedged position. So something that doesn't have to do with the U.S. stock market, the U.S. bond market. So what we would typically do is we would do private placements where basically what would happen is we would have clients put in $100,000, $200,000 and we would invest in raw land, or we would invest in some type of real estate deal. One time we had a real estate deal all the way over in France. So we had diversification because it was another country, that it was real estate, it wasn't in the stock market. And so we would list that for certain investors it might be a suitable investment for them at some time. There's also the controls and constraints portion to it. So, for example, you might say, I'm okay with losing some money, but once I reach a certain loss, we need to reevaluate our objective goals, our investment objectives. So there are controls and constraints. And constraints is, again, what we invest in and what we don't invest in. Now, I believe that every single person, including your spouse if you're married, needs to have an investment policy statement stating, because what's going to happen is, and this happens so many times, I remember back in 2008, the market's going down, and you know what? Did our clients call us? No. You want to know why? They had an investment policy statement. They knew that we had a plan. We had a current allocation, planned allocation. What's our philosophy, our objective, our roles and responsibilities? Our objective was not to time the market, not to get afraid when the market drops, okay, and sell out. All right. Our investment objective was long-term growth. Another investment objective could be income. Okay, maybe we're at the retirement stage right now and all we need is income. So there's different types of investment objectives. So just remember, before you invest, you need to understand your risk tolerance and you need to have an investment policy statement. The IPS is the most important document in investment planning. So let's talk about investment expenses, because investment expenses can be very, very high. All right, I'm going to talk to you guys about ETFs, index funds, and I'm going to talk to you about mutual funds, which are in two different categories. We have our load mutual funds and we have our no load mutual funds. So a commission, we've talked about this a little bit before in class, but basically if you purchase ETFs, if you purchase a stock, okay, or just a buy or sell, so let's say I want to buy 10 shares of IBM, all right, you see Scottrade might have something going on, well, we can place trades as low as $7.95, okay, that's a commission that you pay. Now you can purchase ETFs and mutual funds without paying what's called a trading commission, all right. Most ETFs now you can buy without a trading commission. That it depends on your brokerage firm that you have. Some still do charge a fee. Now, what is a load? Okay, a load is a charge up front or at redemption. All right, and a load is the commission that you pay to the person for selling you that investment. Now, if you're a fee-only financial planner, you will not invest clients' funds in load funds because you don't receive commissions. So expense ratio is something we want to look at. Typically, and you want to write this down, investments that are passive investments, meaning that it's an index fund. An index fund, I keep talking about this, let me explain it a little bit better. An index fund is a very, very low-cost fund because all it does is track an index. All right, there's no mutual fund manager trying to buy and sell stocks in a mutual fund to outperform something. There's no active trading. It just copies or mimics the S&P 500, the Russell 2000 index, and so its expense ratio, because there's only really bookkeeping and accounting, you're not really paying a mutual fund manager, is very, very low. It should be 0.5%. All right. Typically, you want most, if not all, mutual funds to have an expense ratio of less than 1%. Okay, so it is a measure of what it costs an investment company to operate an investment. All right, the fund's operating expenses basically are divided by the average dollar value of its assets under management. Okay, remember that operating expenses are directly taken out of the investment's assets, and they're going to lower the rate of return on a fund for an investor. For example, hey, I can get you if an advisor says we're going to get 9% rate of return this year. Oh, okay, does that include your fee? Oh, no, that doesn't include the 1.5% that I charge. So what's your real rate of return? All right, 7.5%. All right, and that doesn't sound like a whole lot, but over 5, 10, 15, 20, 25 years, a high expense ratio can really, really affect your overall nest egg when it comes to retirement or putting your kids through college. So depending on whether the fund is an active or passive type of fund, the operating expenses are going to vary greatly. If like I said, if it's an index fund, they're going to be very, very low. If it's an active fund, like let's say we have something called a long-short mutual fund. It's kind of like a hedge fund where they're actively trading daily, and while they're trading, they're trying to get you a high return with a high risk. That's going to be more expensive because there's more requirement by the mutual fund manager. The thing to note is the largest part of an operating expense is to pay the manager, okay, the investment manager. Other fees, we have custodial fees, accounting and administrative fees, which all should make pretty much basic sense. Someone's got to account for the money. Someone's got to send out statements. Someone's got to do all of the back office type of things, right? So costs associated with mutual funds these do not, what I want to tell you is an expense ratio does not include a load. So you could buy a mutual fund, and a load is typically 1 to 2 to 3%, but it can be up to 8.5%. All right, charge of the mutual fund. That money is not put in when you invest. So if you invested $1,000, but it had a 1% load on it, then basically you would not have the entire 1,000 go in. You would have a little less than that. So you're already starting a little bit down in the investment. Okay, but the loads are different from in an expense ratio. Okay, so know that there's an expense ratio for the operation of the fund, but on top of that there could be a load unless you do a no load fund. So loads versus no load funds. I think Fidelity is probably the company that comes out the most and says we have so many no load funds. No load funds are the best funds to choose in my opinion. Okay, there are a lot of them out there. A load is a commission, again, paid to a broker or a planner. There's really three classes, but the classes that I want to specifically pay attention to in this class are what are called our Class A shares and Class C shares. All right, so the Class A share is the example that I just gave you. You're going to invest $1,000 in a mutual fund, but there's a 1% load at the beginning of the mutual fund. All right, and if there's a 1% load, then the money after the 1% goes in the investment. So basically, the advisor says this is, or the stockbroker or the mutual fund broker says this is a good way because I get paid up front, and then whatever it grows to, if this $900 that goes in grows to be $1 million, I'm never paid anything again, right? So that's kind of their way of saying that. Now there's something also called a back-end load, and it's also called a Class C share. And the Class C share means that, okay, that full $1,000 will be invested now, but 20 years from now or 15 years from now, when that is worth $1 million, okay, then I get 1 to 2% or whatever the Class C share expense is. So FINRA does not permit mutual fund sales load to exceed 8.5%. So you got to be very careful when you're screening for mutual funds. I haven't ever really seen an 8.5%, but I mean 8.5% is a lot. It really is. Okay. Remember that a no-load fund is permitted to charge purchase fees, redemption fees, exchange fees, and account fees, none of which is considered to be a sales load. And we also have the B share, which is a continuous charge. So the A share, let's talk about that in more depth. These shares are typically charged at front-end sales, okay? But in addition to a Class A share, there can also be something called a 12B1 fee. I know we're getting kind of technical here, but a 12B1 fee pays for the marketing of the fund, okay? So you can have, and that's part of the expense ratio. Remember that often Class A shares offer you discounts called breaking points, all right, on the front end sales charge. So the more money you come with, the lesser the percentage is going to be, right? So here's an example of breakpoint schedules, okay? If you're investing $1 million or more, there's not going to be any load. If you only have 500,000 but less than $1 million, there will be a 2% load, and you can see how it goes. So the less money you have, the higher percent the load's going to be, right? But again, you can find several good mutual funds that will help you get to your retirement objective and achieve your goal without paying these loads. B shares, I'm not going to go into a whole lot of detail, but these do not impose a front sales charge that is deducted from the initial investment. B shares are really a contingent deferred sales charge you pay if you sell your shares within a certain number of years. You could have some type of redemption fee, but it's a kind of a continuous charge. Here's an example of the selling B shares. It's not really important because I said this class we're not going to go into too much detail on B shares. Class C shares, these shares typically do not charge a front-end sales charge. Remember, these are going to charge a fee at redemption. The nice thing about this, I would say, is that all of your dollars go to work for you right now. Okay, but at the end of the day, when you sell out and you get rid of those shares, then guess what? Then you have to pay your load. So loads versus no load funds, staying on that theme. The fund is permitted to pay its annual operating expenses. Okay, and we're talking about no load funds. So it won't have a load. It won't be charged. It can still charge a 12B1 fee. All right. But it cannot have a service fee that exceeds 0.25%. All right. So let me ask you a question real quick. Which load funds are better? The Class A, the Class B, the Class C? Well, that's kind of like asking the following. Which one would you rather have if you had these options? A punch to the face, a knee to the stomach, or a foot to the groin? So The point is that no matter what you were paying a sales charge on top of funds expenses, and that most of the time really affects your overall rate of return on an investment. So before purchasing any mutual fund share class, determine whether that class is in the interest for yourself or the client. A fee-only financial planner will not put his or her clients in load funds. Typically what they will do, and we talked about this, is called assets under management. If you come to me with $1 million of investments, I may charge 1%, and I will invest you in mutual funds, index funds, we might purchase individual stocks, but I charge 1% of the assets under management. Mutual fund filters are awesome, okay, and you can be used to find a mutual fund investment that fits your investment objective. There are professional software programs out there, such as Morningstar, but there's also free items as well. Like, for example, this is the Yahoo Fund Screener, and let's see if it'll take it to me. I'll have to bring it over here. Okay, so let's say that you are, let's say that you are interested in, let's say you want a large cap growth stock. Okay, so a good example of a large cap growth stock would be Google, because they don't pay out any dividends. All right, you could also look for the family. For example, you might have been told that T. Rowe Price has exceptional mutual funds, so you could choose that. Morningstar rating, that's usually that 1 star, 2 star, 3 star, 4 star. I think there's a conflict of interest between Morningstar. I wouldn't really go by Morningstar rating, okay? So you could also look at this though. What's the minimal initial investment? If I've only got $5,000, well, then I need it to be probably less than $5,000. Are there any loads? No, I don't want any loads. What's my total expense ratio? I want to see all funds that are less than 1%. All right, there's other things I could do, like, for example, I could look at, okay, what's its 1-year return? We could also look at risk. Okay, is it a risky investment? Okay, so I could click Find Funds on here. It says no match was found. I think there's probably just an issue with the. I'm going to do any here, and see if I can get something pulled up. There we go. Okay, so here we go. Here is the ING T. Rowe Price Growth Equity Portfolio. Here's a blue chip growth. So these are investing in our companies that we know a lot about, Exxon, Walmart, etc. You can see it's all these expense ratios are 0.77%. All right, and you can see it's a large growth. One thing I can do is I can go to what it's called is its profile. Okay, and so what I can see here is that its year-to-date return is 5.54%. All right. It also tells me a couple of things. It tells me who the manager is. It tells me the summary of the fund, what it invests in. And now let's look at fees and expenses. Okay, check this out. There is no fund. There's no max front end sales load on this. There's no deferred load, and you can see what the industry averages are. You can see the annual expense is very low compared to the average of the category of similar funds. You can see the minimum initial investment is $2,500. All right, but the great thing about mutual funds is you don't have to put in $2,500 at one time. A lot of them will do an AUP, or they call it AIP here, an automatic investment plan, where you won't have anything initial that you have to invest, but you do need to initially put $100 in each time. So you can go to the performance and look at the performance information over time if you want to look at that. There's also holdings, so you might be able to see, you know, what are the biggest companies held here. All right, and you know, and you can see here the top 10 holdings: Apple, Google, Amazon. So you can kind of get an idea of what you're investing in. So because if you already own a lot of Google stock, then investing in this is not going to provide you really a whole lot of more diversification. I mean, it will, but you're still adding up more Google. Okay, and risk is something we really need to look at. So risk, and one thing that I want you guys to make sure you understand out of your book, and I'll give you a video on it, is understanding alpha and beta. Okay, So you can look here, and looks like this fund isn't too old because there is no 3-year alpha. But 10 years, the alpha has been 0.35. You want alpha to be over 1.0. What alpha means is that you are paying a mutual fund manager to invest money for you, and that they are doing better than the average market. Okay, beta. I'll also provide a video on beta for you. Beta is basically the S&P 500, the 500 largest companies in the United States. It's kind of the definition. Basically, if anything's greater than 1, and then it's more risky than the market. If anything's less than 1, and it's less risky than the market. Okay, then we have some other ratios, the Sharpe, and then we have Trainer, and then we have standard deviation. So that's just a kind of a cool way to look at the investments. So asset classes. When we're looking for funds, again, we're looking for, okay, what is the asset class? Are we looking for a stock fund, a bond fund, etc.? The objective, is it growth? Are we just looking for growth? All right? Or there's something called value. And when you're looking at a value fund, that means you're actually paying a investment manager to find, in that mutual fund, to find stocks that are undervalued. Or maybe you can get a blend. All right? You also can choose between country or region. You always want to ask, is the fund open to new investors? Some of the biggest funds out there that have done so well, you can't get into. All right, so you can do all these research, going through your selection criteria when you're screening, and you would actually come out and be very disappointed that's not even open, or the minimum investment, that you can't even invest in it. What is the minimum investment? You can look at performance, like I said just a minute ago, 3, 5, 10 years since the inception. We can look at the inception date, the expense ratio, is there a load, no load. Remember, the higher the standard deviation, the more volatility. The higher the alpha means that you're getting the manager's actually making a difference, and they're actually the fund's doing well. And beta is how relative in risk is the investment to the S&P 500. Okay. The next thing is called a prospectus, and let me show you an example of a prospectus. The prospectus definitely can kind of put you to sleep. All right. And this is the Wellington Fund. So here's a summary of the Wellington Fund, and you can see that it has a lot of information in it. Okay, the job of this perspective is supposed to say what this investment holds, what the risk is, and who this investor is for, and more detail. But what I like to actually do instead, I personally like what's called a fund fact sheet, because it's easier to read than a prospectus. So let me show you what the Vanguard Wellington Fund, the same fund fact sheet, and it kind of gives me an idea. I'm a graphs kind of guy. I need to see graphs. I need to see information at a different. I need to see it different ways. I can't just read. I've got to see visual aids. So let's have that pull up real quick. Okay, so this is the Vanguard Wellington Admiral Fund. So this is an asset allocation fund, meaning that there's a combination of stocks and bonds in here. So it's already a diversified fund. It tells me quickly that this investment is appropriate for someone willing to balance risk of principal. So I can look at that easily and say, hey, is this an investment for me? All right. I can see on the investment side, is it, from the risk, is it low to high? I can see, let's see here, on geographic. So how much is in the United States? How much is in other countries? Okay. I can see also what kind of bonds, corporate, mortgage-backed bonds, government, municipal. Okay. And then over here comes all my information. So I can see my alpha. Look, it's 1.1, so that's better, right? The beta is 0.97. Okay, beta is 0.97, so That's below 1, so it's a little less risky than the S&P 500. You can see that they're saying that's their benchmark. So I think, in my opinion, and down here, here's our expense ratios. Check this out. The net expense ratio is 0.19%. Now, when you buy mutual funds inside a 401k or with a company-sponsored 401k, especially if you're in a big plan, like this is the Texas Saver, stated for Texas Saver for the state of Texas employees, they get discounted pricing. So that's why the costs are so low. So that is the discussion of mutual funds. Okay, what I would like to say is that risk tolerance is extremely important. All right, no load funds are good to go with, and that it is okay. And I do believe that you do need a combination of index funds and actively managed mutual funds, because it has shown, research has shown that the actively managed mutual funds have lower volatility. So that is the discussion on the basics of mutual funds. Hey.
Hey.
I'm here. Sorry, I was recording the lecture. Come on in. What's new?
Oh, nice sweater.
Oh, yeah. Thank you. Nice workout clothes.